All right, so Laura writes in, she and her husband are both 58. They got $2 million bucks and they wanted to know if they should dump everything into preferred stocks. They say in the research they've done, it seems like the best bet at this time. Um, yeah. All right, so I did some, we're going to go to Schwab because Schwab's website kicks ass. I typed in for screensaver a 4 to 6% current yield. I did high investment grade A or higher, and we only got 3 holdings that match that, and these are the same company. Enter G. All right, so we got a call price at 25. So prefers are typically issued at 25 bucks a share, if that makes sense. So they're trading below the initial amount, or the par value, if you will, which means the yield will be higher than the coupon, which is exactly what's happening here. So the coupon is at 4.875, so 4 and 7/8. All right, this is actually what you're getting on a quarterly basis, a monthly basis. I don't think it pays monthly, or a semi-annual or an annual basis. I don't know how much this pays. It doesn't matter. But there is a call. All right, so that means if they start feeling that the yield is getting too high relative to the coupon, or the coupon is getting too high relative to current coupons out there, they can call it back. In this case, if they called it back, they'd pay you 25 bucks, even though you're only paying, you only bought it for $23.97. I hope that makes sense. I don't want to get too deep in that right now. But point being is, you're paying a lower than par value to get a coupon of 4.875, which means your yield is 5.08. All right. Again, I don't want to get too deep in this one. I've done other videos on how these things work, but just remember, if the yield is higher than the coupon, the current yield is higher than the coupon, that's the coupon, you are getting a price discount relative to par value. All right. All right, so we got one firm. I don't know the first thing, but Entergy. So you're getting 5.08. That's what they're paying. Now let's take a look at. I don't even know what Entergy stock ticker is. Let's see if we can't find it. Entergy is on the U.S. stock, New York Stock Exchange. So it's going to have a 3-letter ticker, which it does, ETR, and we're going to see what Entergy is doing right now. We're going to go to. I just want to get a quick gauge of PE ratio and the current dividend yield. ETR. Yeah, there it is. Right now, it's got a PE ratio of 23. It's got a current dividend yield of 3.34. All right. So there you go. So what we're getting here now is not a very highly traded in terms of the. It's not trading at nosebleed valuations, but it has. I mean, it's done well over the last. Well, actually, right now it's trading. It was at 120 back in 2008. So price to price, it hasn't made any money, but it's paid a dividend. I presume it's paid a dividend the whole time. I don't know. All right, so that would so basically right now, Entergy, the yield itself is 3.34, but the preferreds are only paying about 175 basis points more than that. I wouldn't buy that, but that doesn't mean you shouldn't. I would rather take the risk, and I'll show with you why here in just a second. Buy the stock outright. All right, so let's go. I don't think anything's gonna be here yet. Nothing there. So let's go now to. We'll go down a little bit in the credit quality B, and we got 126 to choose from. So you can see, yeah, look at that. To go from A above A investment grade to triple B, it really changes things, doesn't it? Now, so 4 to 6 is our range, triple B, and now we got 123 to choose from. I wonder if you can do it in category of like financial. Let's see what we got here. So we got Aegon, Allstate, American Financial Group, AT&T, Athene. I just want to see if we got any banks in here. Let's look at Bank America, see if we got any banks. Yeah, Bank America. All right, there we go. This is what I used to sell when I was a broker. Bank America, Wells Fargo, Wachovia Bank used to be. All right. So here's a Bank America 5.875. All right, the yield is lower than the coupon. So now the yield is lower than the coupon. The coupon's at 5.875, 5 and 7/8. However, the yield is 5.78%, which means it's lower than the coupon, which means the price of this preferred is above par or lower than par. If you said above par, you win the Jeopardy challenge. So right, so you're paying $25.40 for this, all right, and this again has a call price at 25, so they can call it back if they want. Isn't that interesting? Now, if you look at this right here, this got a 4.13% yield. I can't see when that matures. I'm not sure if some of them are perpetual, some aren't. I just don't know. I mean, this one I can't. I guess let's click on see what we get. It was on right there. Let's see if we get any other info on this, shall we? 1200 Series 2. I was just real quick looking at it here. Next payment date, do they pay? It looks like quarterly. It's got to be quarterly, right? They can't pay monthly. No, they pay quarterly. All right. So they pay quarterly. You're going to get 76 cents a share. 21 in 2021, you got 76 cents a share. All right, gotcha. Call price right there. Next call date, June 2022. So they can call this in June. And what's the price right now? 18. So they're not going to call. Why would they call it if it's trading that well below? They're not going to call this. I mean, they're not going to give you $25 to call in a stock, a preferred stock that's trading 18. So that's not going to worry about. All right. So you're going to get regular dividend of 18 cents a share here. All right. 11 million shares outstanding. All right. Okay. Good. Callable exclusive to cash. So when they call it, they have to pay you cash. They're not going to give you $25 a share. It's just not going to happen. All right. So that's good. So let's look at Bank of America stock, shall we? Because again, the question that comes to my mind is why would you own the preferred if the stock looks pretty reasonable relative to the preferred? Because remember, the preferreds, I'm going to show you just a second how this works with preferreds, because I think there's a second point of this. BAC, stock's trading at 37.02 right now. PE ratio is 10. You're getting a 2.29% dividend yield. All right. So there's a couple preferreds you could look at. Let's just do one more here. We're gonna go to let's just do this for simplicity, and we're gonna go to other matches here, and we'll come down. We'll say I don't want to touch AT&T with a 10-foot pole. Let's go over here, and we're gonna see Duke Energy. There we go. All right, so this got a 5.625 as a coupon. It's got a current yield of 5.49, so basically pretty doggone close to par. But 63%, 63 cents over par value, which means the coupon is higher than the current yield. All right, and that's a BB minus. Isn't that interesting? So again, if we look, so you're only literally going to get 5.5 is what you're getting on Duke Energy. And if we look at Duke Energy to the stock, and there's a reason I'm saying this. Well, I keep saying why we're looking at the stock. So right now, Duke Energy is paying 3.44 in the yield, and it's got 95 PE ratios. That's high. All right, so let me share with you how prefers work. As long as the dividend gets paid, as long as there's 1 cent on the dividend, the preferred stocks will get paid. That's just a fact, Jack. So you're always going to get, as long as the dividend isn't cut to zero, and that's why none of these companies cut their dividend to zero. AT&T didn't, GE didn't, none of these guys will, because they do not want to have the preferred shareholders get smoked. Because a lot of the premium investors are in prefers as a way to kind of get a juicier yield in bonds, if that makes sense. You could actually look at prefers, what they're paying relative to bonds right now, and the bonds would be probably 3.5. The prefers are 5.5. Well, because there's risk. Because if they don't pay the dividend, you don't get your preferred. All right, if the stock goes belly up, you're losing all your money. It's just a fact. But I'm going to show you something here now. Who's 58? Don't just go all into prefers. You're going to. You need growing dividends is what you need. Growing dividends. I'm going to prove it to you. But on a side note, I put a lot of people preferred stocks back in 2006 and 7, and I got smoked, as we all did, because the financial crisis happened and the banks took it on the chin. Preferred stocks got smoked. If you would have bought them in 2009, you're freaking loving life. But I'm telling you, man, do not fall into the auspices that preferred stocks are risk-free. They just were not. And I'm going to show you right now, especially relative to stocks, they didn't give you a whole lot of cushion. That's for doggone sure. So we're going to compare PFF, which the iShares is the longest ETF on preferred stocks I'm aware of, and it goes back to 2007, if memory serves, January 2000, April 2008. And we're going to look at the large cap value index fund from Vanguard. All right, so prefers are kind of like bonds, they're kind of like stocks. All right, there's not much difference than a bond. It pays a fixed interest rate. But it is a dividend. All right, what are you doing, buddy? So it pays a fixed interest rate. There's no real upside to it in terms of like a bond. You get at maturity, you get $25 a share typically. Usually, they don't ever mature, frankly. So you're going to get that fixed dividend preferred stock for the rest of your life. You can't reinvest in it. It's just like a bond where you take it as cash. Anyway, point being is, let's compare the two. All right, so we're going to look at iShares preferred shop at iShares, and right now I think that's paying. Let's see, what is PFF doing right now? PFF is paying right now 4.74. All right, so we're going to compare PFF versus essentially VTV. VTV doesn't have that. Well, we could actually look at first VTV. VTV is paying half that. All right, so let's see what happened over the last. Let's make sure we're reinvesting dividends. Yep. All right, good. So we're going to look at the performance of the two, and here we are. This is VTV. We put $10,000 in 2008, and VTV is now worth $30,400. We put $10,000 in 2008. PFF is worth $20,000. So we smoked. We smoked in terms of upside. No other way around that. Now, at the end of 2015-16. PFF was still outperforming. Well, so you'll think. I'll show you here in just a second why that's misleading. Oh my goodness, PFF right here was down 24%. So it didn't give you a reprieve that a lot of people thought, as I did, in terms of downside risk. We still got smoked. In fact, look here so far, 2022, PFF is getting smoked down 13%. All right, but it's going to get worse than that. Our max, we got the max drawdown. Yeah, max drawdown right here. Preferred is actually higher than VTV. This is like an S&P 500. That's how risky it was, pulling money out at the same time the market's getting killed. Your ship is sunk. All right, so now what I'm going to show you here, let's take the dividends off the table. All right, so we're going to take so again, at the end of basically 15 years, VTV is much more valued than PFF, but it took the first 10 years basically to get there. All right, so I mean that's just a fact. It took the first 10 years to get there, but I want to show you something here. We're going to take the dividends off. All right, we're going to not reinvest the dividends. Watch this. And I want to show income as well. All right. And this is where, in my opinion, this is all that matters right here. So now we're not reinvesting the dividends. We're taking the dividends off. All right. Oof. Now PFF is down to $8,000 when you're spending down the dividends. The value index is at $21,000. Yeah. And then we're going to see income. So look at how much more, the blue is the PFF. Look at all the income you're generating off PFF. Almost, yeah, about 3 times what the value index was. Look at that. Does anything kind of jump out at you though? Look at that. 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 Whoa, right there. 10 years later, the value index is paying more. Isn't that interesting? Because growing dividends make all the difference. So now she's 58 years old. Let's just fast backtrack till we'll say Laura was 58 here. She's like, look, I'm getting $665 per $10,000 invested per year. That's a 6.6% yield. Yeah, sure are. And I'm only getting 253, a 2.5% yield on VTV. And right now I'm still getting less than 2.5% yield. No, you're not, because look at that. If you invested and just let it sit there, look at the income you're generating now. You're actually getting more in value than you were on PFF. And the reason for that is simple, because you have more value of the portfolio by far. And we're talking more than double, 2.5 times that. Now she's 68 years old, and she's sitting on more income and a higher account value in VTV than she did in PFF. This is the issue of being suckered into these high yielding accounts. I'm telling you, man. So I think we can do it without reinvesting, or with reinvesting, and just see what it looks like here in terms of income. It's going to get even better if you reinvest it for VTV. I'm going to hit analyze. So check this out. It's literally here. Look at this. So now we're reinvesting in PFF. You can reinvest in PFF. Bonds you can't reinvest in. I don't think you can preferred stocks. I think you have to take as cash. But PFF you can, because they're basically taking all your dividends that you're reinvesting and buying other preferreds. But check this out: 685 to 256, 991 to 631. Huh? You see how the growing dividends of VTV is growing? In this case, it's VIVAX as a mutual fund. What do you think is going to happen as we go forward? Well, you know what's going to happen as we go forward. VTV is going to grow bigger and bigger and bigger relative to PFF. All right, so now let's just say we're going to take $5,000 a year. We're going to reinvest our dividends, and we're going to take $5,000 a year, or I guess $500 because it's a $10,000 investment, and we're going to adjust that for inflation. Watch how much worse. You have to have growing dividends. There's just no two ways around that, man. I've said 1,000 times a Sunday. Look at this. All right, so now we're taking 5% a year off. PFF smoked us here at the beginning of our retirement, but look what's happening. The growing dividends of VTV and VIVAX is the same thing. I mean, look at that. If you're only 58, man, you got way too much longer. And now VTV is 12,253, where the preferreds are down below our initial investment value. And if we look at income, look at the income change. Literally, because we're dipping into our principal, our income is being reduced. I hope that makes sense. So here we had a high income 749. Now we're down to 480. Here we had a low income. So the same year we had look at that. The same year we had 749 of income in PFF. We only had 164 BTV. Fast forward till last year, we had 480 in income and 268 in VTV. So we went down from basically 300. We basically went down 40% income for PFF, but we went up from 164 to 2. We went up by, and that's but basically 40%. So PFF went down by 40% income. VTV went up by 40% income, and on top of that, we have a much bigger account value in VTV than we did in PFF. I don't think you can. And then we still look at the risk. The drawdown of PFF was 57.4, crazy. The drawdown VTV was 54.7. There's actually more risk in PFF than there was in VTV. Now you can say it's because of this. Well, okay. Could that never happen again? Of course it could. So if you're buying stocks, you might as well buy literally stocks. Buy stocks. Anyway, I wouldn't do it, man. Now, look, if you want to put a quarter of it, I got no qualm with that, but I wouldn't do that. Growing dividends is always the way to go. Always. You know, if you're 88 years old, you're like, I just want to play shuffleboard. Well, maybe not. But if you're you got too many years ahead of you to be locking in fixed income. Anyway, love to hear your guys' thoughts. We'll see you.